Welcome, everyone. Thank you for being with us on the second day of European Blockchain Convention. I hope you had a great day yesterday. We learned a ton. We shared a lot of new insights from the people working in the blockchain industry. So today we continue with more sessions. I hope you can be as engaged as you were yesterday. And I'm very honored to introduce our next session. They will cover topics such as commodities, financial instruments, the new era of financial services. So welcome on stage.
Thank you very much, Daniel, and thank you for the invitation and an amazing convention so far. Yesterday was an amazing day. I had a lot of fun looking and watching the rest of the sessions, and I'm very thrilled to be part of this panel discussion where we're going to talk about the new era of financial instruments and commodities. And for this purpose, we have four gentlemen from the industry. And I would like to kick off this panel discussion with a little bit of introduction. So a little bit about myself. My name is Maria Eneva-Olms. I'm based in Frankfurt, Germany, and I'm manager at LPA, where we develop capital markets and regulatory technology solutions for financial institutions. I am also the creator of Ledger Nation, which is a blockchain experts community, and we publish interviews about the career paths of blockchain experts and about investing in digital assets. So I am extremely passionate about the whole topic of investing and investing in digital assets and the future of all types of investment asset classes, which is why I'm thrilled to be part of this panel. And I would like now to give the word to the rest of the panelists to introduce themselves. And maybe in your brief introduction, you can also say a couple of words about how you got into blockchain and when you got into blockchain. Martin, would you like to start?
Okay, elderly's first, you reckon? That's okay. Thank you very much. Yes, my name is Martin Müller. I run the capital markets business at the board level and the finance business at Dekabank. Dekabank is the fourth largest asset manager in Germany. We have sort of 5 million direct and 50 million indirect customers. And we deal with all the savings banks clients. As such, obviously not per natural, but I've had a very good sort of and passionate colleagues about blockchain who got me into it in 2016. And ever since, I've become a sort of blockchain believer, not so much in cryptocurrencies, but into the technology itself, which is very, very mature. And given that, we've started with our own initiative called SWIAT, Secure Worldwide Interbank Asset Transfer, which we're trying to promote because we're going to discuss about this obviously later on. But I do think that in order for banks to be connectable, we need to go for a joint network because we have to overcome this hierarchical infrastructure which we currently see. So I'm very eager and very sort of pleased to be part of this very worthwhile panel.
Thank you very much, Martin. I'm very excited to talk about the SWIAT solution as well. I watched your panel yesterday, and it would be great to share the technology and the solution with us today as well. So Arno, do you want to go next?
Sure, Maria, thank you very much. My name is Arno Pernthaler. I'm head of corporate and business development at Atomyze AG. I myself started working in blockchain at the Blockchain EMEA Center of Excellence of Deloitte in Dublin back in 2017, where I consulted different types of clients on what it means to work in blockchain and what impact it has on their organization. So general strategy assessments and proof of concepts. That's what I was working on. After that, I've been working for Swisscom Blockchain AG. Swisscom is the largest telco in Switzerland. It was the first large company that actually started its own subsidiary focusing only on blockchain, at least in Switzerland. Since over 2 years now, I'm with Atomyze, and we are building a digital marketplace for tokenized commodities for both the industrial world as well as the investment world, looking to get price exposure on commodities that they couldn't access through traditional capital market infrastructures.
Wonderful. Thank you. It will be very exciting to hear how you do that and your vision of the future of the commodities market. Dotun, do you want to go next from London?
Sure. Thank you, Maria. And thanks for having me, and nice to meet you all. So Dotun Rominiyi, I am Director of Emerging Technology for blockchain and DLT and digital asset architecture and strategy at the London Stock Exchange Group. I've been with the firm coming up to 3 years now, largely supporting and steering all of our blockchain and DLT related initiatives. Prior to that, I spent the last sort of 3.5 years leading kind of blockchain startups professionally. So I've been in this space for just over 6 years now. It's been an interesting ride, and I'm really pleased to be a part of this panel today.
Perfect. Thank you very much. And another representative of a stock exchange is David. So David, please.
Yes, good morning or good afternoon. And it's great to be here. Thank you very much indeed for the invitation, Maria. I do appreciate it. So I'm David Newns. I'm the head of SDX, of Swiss, of the Sixth Digital Exchange. I've been involved in blockchain since around 2014. I was privileged to be on the round table that led to, that ultimately became the working group, that ultimately became R3. So that was a very interesting experience for me to be there at the outset. But my direct involvement with digital really kicked off while I was at State Street at running FX trading and multi-asset class independent platforms. We were white labeling our technology to provide crypto trading functionality for the industry. I moved to SDX in 2018, in October of this year. SDX has been a significant project in this space since 2018, when Six Group made quite a considerable statement of intent by backing the rollout of a regulated financial market infrastructure based upon DLT technology. So the CSD for Swiss Digital Exchange, the Central Securities Depository, is based upon R3's Corda DLT technology. And in September of this year, we were the first financial market infrastructure provider regulated FMI to be provided with a license to operate a CSD on DLT anywhere in the world. And then at the end of November this year, we issued the first ever digital bond on a regulated FMI. We've also been conducting some very significant and high-profile experiments with the Swiss National Bank and various other participants in Project Helvetia and Project Eura on the CBDC side of things. So great to be here.
Great, David. When I read the news about the issuance of the first bond on a regulated exchange, that was very, very exciting. So we can talk about this later when all of you can share with us actually the use cases you're working on currently and what have you already done on the blockchain. But maybe the first question that we should start answering is, we're talking about the future, the new era, but how does this new era actually look for you from your perspective? So let's maybe first talk about the new era of financial instruments. How does this new era look for you? Maybe, David, you can start.
So thank you very much. Yes, I think it's categorized by a number of things. One I would say would be obviously the reduction in the number of trusted parties required to provide services down the value chain as a result of the fact that you can achieve the instantaneous settlement with DLT technology. So one of the promises has been that notion of the atomic swap, whereby the delivery of the asset and the receipt of the payment is simultaneous, rather than the trading happens at the point of, rather than the matching happens separately to settlement and payment. So what we have with DLT-based systems like SDX is the ability for that entire T+2 settlement process, with all the various intermediary steps and all the reconciliation steps that happen in between, to be compressed into one instant step, which is atomic and indivisible, where trading and settlement occur simultaneously, which reduces the requirement for you to collateralize with a central clearer, reduces the settlement risk associated with that process in the first place, And it also means that you can take receipt of your funds if you're selling an asset instantaneously rather than wait for 2 days to actually take receipt of that. So there's a massive reduction in risk associated with the compression of that process. And in addition, some significant agility that comes from the fact that you can then manage these assets in an instantaneous fashion. So you can get in and out of these assets instantaneously rather than wait, which I think will drive a revolution in the processes depending upon these assets, such as collateralization and so on. I think that's one aspect of it. I think also we should look. I'm sure my counterparts on the call here will talk about adding the additional elements of intelligence around an asset. So using smart contracts to provide additional lifecycle management to an instrument which are currently essentially quite dumb. So that ability to manage things like corporate actions through the smart contract process in a far more agile and substantial way than we do today, which is a very clunky multi-step process. Again, reducing costs and adding functionality and efficiency to the existing system. So I think in so many dimensions, whether it's trading and settlement or whether it's the actual functionality of the instrument itself or the issuance of completely new instruments, I think that's going to be something that characterizes this space as we embrace this technology.
Absolutely. Thank you very much for this overview of how you see the future of financial instruments. Martin, what is your opinion about the future?
Well, it's always the most difficult part to predict the future because mostly you're wrong in your estimates.
Get your crystal ball out. And
I would say, like a colleague of mine always said, most people overestimate what they can actually do and achieve in a short time, but they underestimate dramatically what will happen in the next 10 years. And I guess that phenomenon David has really outlined very much so. Blockchain is here to stay and not to sort of go away. So it's a mature technology, and it's not a question of how it's going to be deployed, but just in what pace. That's why our assessment is if you take the smartphone as a device, but also as a technology, it took 15 years to conquer the world. It will take blockchain to be sort of prevalent a lot less time. And we believe that this whole idea about doing POCs and proofs and all this sort of stuff is gone. You just simply have to go for it. I mean, that's what the SDX has done. That's what we have done now, because clearly in the cross-border settlement, that's where you see imminent changes, because this seamless transfer of asset will really reduce a lot of risk and will make things more efficient. At the same time, I guess the value chain itself is sometimes challenged in the financial and capital markets area. But however, roles will not simply disappear. Yes, we will see some new players, but once regulation is fully out there, obviously also some of the dinosaurs will move. And I would say that my forecast is in the next 5 years, the majority of new issuance, for example, on the bond side, will gradually just become digital because it's more effective, it's cost efficient, and there's so much more benefits. Obviously, currently the regulation is still pointing towards the opposite of really making use of DLT technology, because this idea that you only have to have a central register is in and of itself a detriment to the idea of having a shared technology. That's obviously something where the market and the regulators will have to play out, but it will be a key feature. And the second major point is, and I guess a couple of panels later, this is being discussed. There's clearly this element of cash on chain, which is something that everybody's looking for. And I find it disappointing that most of the regulators are looking to the retail, for example, euro. This is going totally, to me, in a wrong direction, because why wait 5 to 6 years to implement with all the repercussions a retail euro when we could have cash on chain already? The German Bundesbank, for example, has a trigger solution which we could easily introduce into RTGS, no issue, and we would have our existing and trustworthy system, but yet we would have cash on chain. We also propose another solution which would encompass the capabilities of SWIFT as a messaging system with a digital signature, and we could have cash on chain immediately. this would be probably the biggest game changer and accelerator on the blockchain technology to implement that into the cross-border and also the other settlement systems. Because I believe whilst we will see a very exponential development of the technology, the traditional securities will not just simply go away. There's a certain average maturity, and we have to convince the decision makers that it is a process where we move gradually. And you don't have to spend, I don't know, 100 million per institution to build everything from scratch on the green field. No, it will be an evolutionary process. That's why we at Deka, for example, have managed to put traditional securities, as we call them, on the blockchain and just trade them as a sub-custodian. Very smart way to use the existing system, but we've done, for example, delivery versus delivery, what David was just talking about. We can do delivery versus delivery. We've done it also in external trades with other German banks, eliminating that risk. So the potential is there, and it's got sort of up to the market participants to really make use of it, and hopefully also get the regulators on board. And last point, the Swiss are clearly on the forefront in terms of the standardized approach to regulation. I do see like Germany has now also done the same thing with the crypto Wertpapierregister. So we have just, as of yesterday, issued our first crypto security as a bearer bond and sold it to other banks. We will also see now the same for funds, and lately, in the next 2 years, the same will apply for equities as well.
Perfect. Thank you, Martin, for your overview of the future. Also very interesting points. Dotun, how do you see it?
Thank you, Maria. I think I would absolutely agree with the points that have been made so far. I think I would just add as an extension, I think when we look at how the technology is maturing and where the initial kind of use cases of adoption are building, I think there seems to be, a lot of traction when we look at the kind of primary market side, and specifically in the private markets. And these are traditionally markets where largely, there's a lot of manual process, a lot of paper-based workflows that are being carried out between multiple organizations across, the activities of issuance of an asset, capital raising, asset servicing, and various other facilities, ad hoc trading of assets across the ecosystem. I think these are really areas where the technology really comes to the fore as a fairly low-hanging fruit use case, because there is no existing infrastructure, and so it's a great opportunity to develop and grow and build new technologies. Essentially, what one would qualify as kind of private markets FMI of the future, in a sense, to really kind of digitize this landscape, digitize its workflows, and really add efficiency, reduce time to market, and then increase access to assets as well, hopefully bringing down the costs of some of these activities, which then better enables investors to get in. Fractionalization is a very interesting opportunity there in terms of being able to increase investor access in some of the larger, more liquid instruments. So let's say, for example, infrastructure or large corporate debt issuances as well. And I think these are interesting areas where we'll see a lot more innovation and a lot of rapid innovation over time, because I think the regulatory constraints in and around that landscape are, let's say, slightly narrower than what you see in the public listed markets, where clearly we've got CSDR, we've got MiFID, we've got lots of very rigid regimes that maybe don't necessarily look at or technologies like DLT in terms of being able to allow it to seamlessly integrate and provide value without having to navigate some of the constraints that the regulatory frameworks impose. But I think over time we will see that evolution. I think we'll see progress from the lower end of the liquidity spectrum all the way up to kind of large cap public. And clearly, that a lot of that work's been pioneered by groups like SDX in terms of positioning infrastructure within that space. And I think over time we'll see a gradual transition to these new technologies. I think the key consideration here, though, is really one of timeline when we think about kind of innovation. I don't see a rapid revolution of the ecosystem. I think it will be a gradual evolution. We aren't in a space, given how regulated we are, where we can move fast and break things, and there are natural cycles of change for large institutions to bring new technologies into their organizations, all the way from budgeting to build to operationalization and provisioning, and then deployment, and then obviously decommissioning of existing and legacy systems. So there's a lot there, I think, that needs to be worked through before we really see this technology penetrate in anger. But I think it's somewhat inevitable, as has been mentioned previously.
Perfect. Thank you, Dotun. And talking about the accessibility of the markets, I have to think about tokenization, because tokenization makes it also possible to fractionalize, to digitize assets. And I would like to give the word to Arno, who is actually an expert in tokenization when it comes to commodities, and ask him, how do you see the future for the commodities market?
Thanks a lot, Maria. The commodities market is very different to what we spoke about just now, the financial services market. The major difference is that in the commodities market, we speak about large bilateral deals between mining companies and between manufacturing companies. So most of transactions are happening in the industry. These are not standardized deals. These are deals where large companies have, multi-year contracts that have been developed over time. So it's really hard to, bring this industry into a more digital and standardized world. And that's a key characteristic, is this bilateral, really illiquid market, especially for the financial services world, to enter and to participate in such deals for the creation of new, as an example, exchange-traded product, exchange-traded commodities. So that's one characteristic. The other characteristic is everything around the sourcing and the supply chain. So this industry is working almost like 20, 30 years ago. So we are in exchange on a daily basis with those large companies who are doing commodity transactions over Atomyze. And they work mainly over phone with contracts they send per post, Excel sheets, so proper commodity trading like in the old world. And this is something where another kind of key characteristic is to bring new efficiency through digitization. This can be with blockchain or not, but it's just simply this transfer to a new environment of how trades are being managed. And the last characteristic of this market is that it's not regulated. It's a really untransparent market, right? So as a manufacturing company of cars, as an example, they have a really hard time to prove where the metal is coming from, ESG credentials, and so on. So this is something that is putting a high pressure on this industry. And all large commodity trading firms are looking into enhancing their products, enhancing their contracts with additional key information that is demanded from their clients and at least from the end consumer that wants to really invest in a sustainable way in a car, as an example. Not just looking at it runs with battery, but actually that the catalysator has metal which is coming from a sustainable area. So these are the three key situations in this industry. Now, if you want to talk about the future, how can you change that industry? That's obviously a huge task, right? Because you also have physical goods and not just financial products, right? And you need to make sure that those are correctly, digitized to make sure that this digital product, which flows through the supply chain from the mining firm down to the end consumer, actually doesn't lose this physical connectivity. So that's one bigger challenge. The other challenge is obviously to bring new market participants to use such a new technology. But we are getting there. There's a big interest to move in this direction from the industry. And what we are seeing now emerging, and I think that's the kind of the future characteristic, are smart products. Now, we always speak about smart contracts, but now we are moving, I guess, in the area of smart products. And I think also David mentioned it before, where you can add not just product characteristic, but also corporate credentials, corporate insights, corporate data into a product, and you can make that tradable, right, through fractionalization that was mentioned before, and you can allow illiquid products also to move into a more liquid market through standardization of the contracts, which are currently bilateral. And then efficiency obviously is a topic for disintermediation, because currently, if you look at the value chain of products being mined moving on to a financial product. We have more than 10 companies involved, right? And through this intermediation, you allow direct ownership of access coming out of the ground, which is revolutionary for the financial, in terms of financial products, because now as an investor, you can invest directly, not just in the stock of the mining company, where you have several risks associated to a company, right? A company could go bust, there are many things that, economic risks around that mining companies, but if you invest now in the real asset that the company is producing, that's a completely different topic. So yeah, I think the two worlds start to merge a little bit, the commodities market, which is a little bit on the side, and the financial world. Now, while things become digitized, you can create different types of bundles of products related to commodities, and that's going to be exciting.
Absolutely. Thank you, Arno, for this explanation of the differences between the two worlds and how they're going to merge and how you see the future of the commodities markets. Now we spoke about the future a lot, but all of you mentioned regulation. And I think regulation is something that is still in progress, and this is one of the prerequisites in order for this future to happen. So let's talk about what has to happen in order for us to arrive to the future. And I think regulation is definitely a big part of it. We can talk about that, and also what else has to happen. So David, do you want to start with your vision?
Yeah, sure, absolutely. I think one of the challenges that we have, so an observation, which is not unique to me, is that what we're referring to here in terms of these technologies, whether it's DLT or whether it's sort of cryptocurrencies and digital assets, is the revolution of the Internet of Value, right? So we move from for this concept of the 1995-96 sort of Internet of Information revolution, which it's been observed that technology emerged into a kind of regulatory desert. There wasn't a vast amount of sort of legalism or a regulation around that was going to be an impediment to the adoption of that technology, and that's one of the reasons why I think that the adoption was so rapid across the board, whether it was sort of retail or whether it was sort of the commercial aspects of adoption. The Internet of Value is emerging into an area of extraordinary regulatory sort of density. Obviously, it's because now we're talking about money, and therefore that's a highly regulatory, sort of sophisticated and extensive regime. So everything that we do is going to be within the constructs put together by regulation, and those constructs have stood the test of time very well and sort of have been optimized sort of since the I suppose the situation we have now is from the 80s onwards. But therefore, shoehorning this technology into a 1980s, 1990s style regulatory regime is somewhat of a challenge. And as Martin alluded to, I think Switzerland is sort of leading the way when it comes to providing clarity around that. So, as a sort of foundation of an environment, ensuring that your regulator is engaged with the industry and exploring these technologies with a reasonable degree of aggression, given that. I think that this is differentiated. It is something which will differentiate states, is how effective their regulatory regimes are when it comes to this particular technology. I think that's kind of key. So at SDX, we'd certainly consider our relationship with FINMA to be absolutely essential, both in terms of us understanding what their requirements are, and also acting as an opportunity to educate them about the possibilities and the benefits, and also the answers to some of the benefits of technology, but also how it addresses some of their concerns. So, and I think that leads to part two to my answer, which is that adoption of this technology is challenging because it's also emerging into an area where there is a significant amount of there is a highly optimized existing infrastructure. So in the financial services sector, it'll take some time, and I think Martin's sort of time horizon of around 10 years is probably accurate for the industry to migrate to this new infrastructure, because there is an existing infrastructure that supports the existing processes and technology that exist today. And for a long time, that will be where the majority activity takes place. So there is a bit of a challenge, both around adoption, which is that it's going to cost the industry money to adopt this new technology in the short term, because the amount of activity that's being conducted over the new infrastructure will be a fraction of the old infrastructure, but it still requires this, it still requires a parallel infrastructure to be in place. So one of the things that I think that participants like SDX and my colleagues around the call here are sort of, it's our responsibility to provide use cases and ecosystems in which parties can come together and learn how to actually leverage this technology and justify the expenditure of their investment in this technology by having more and more effective and provable use cases that exist in the industry. So that's going to be what's going to propel this forwards and generate momentum. Will be, I think, more initiatives, as Martin mentioned as well. I think a very salient observation is that we must move from POCs to real-world implementations, and that's very much what's happening now. And I think at SDX we have a very clear example of that. So real-world examples of the benefits of this technology, but also add the opportunity for participants in the marketplace to get to grips with it and build up internal competency, and also build out infrastructure to support activities not just on SDX but on other genuine production use cases that leverage blockchain. So what we need is momentum by having seen more of these production systems go live, but always with the awareness that unlike simply the adoption of a fintech sort of disrupting technology solution, this is a much more broader base kind of a revolution. It's not simply a point sort of improvements around certain aspects of financial services. This is a move, an evolution from the traditional environment, the traditional infrastructure to a completely new infrastructure. So that's going to take a different set of different ways of interacting between participants, and more partnerships, more collaboration, and I think almost by definition, it's distributed ledger technology. It requires the sort of a consortium mindset in almost every context. It's sort of built into the DNA of the technology, right? That's a bit of a different approach to how we used to do things in financial services, where we would see each other very clearly as competition or partners or customers. Now, if ever there was a case when we were all in it together, it's when it comes to the embracing of this new technology.
David, absolutely. This last point you said, I have to say something that I heard yesterday during another panel discussion at the European Blockchain Convention. A gentleman was saying that currently financial services institutions are building islands. So they're developing their proof of concept on an island. But we have to think how to integrate these islands, or how to make them work together. This interoperability between these islands is the next challenge we have to work on, because everyone is working on a great solution. Yeah.
And I think that actually having production ecosystems, and I know it's a horribly overused word in technology, and everyone gets very excited about the word ecosystem, but I think it's entirely appropriate in the case of distributed ledger. Here is an ecosystem that SDX has now deployed that enables a distributed ledger to be adopted by its participants. Ultimately, they'll be able to build applications off of those DLT nodes themselves directly. So actually we'll build out more functionality that will be essentially not within SDX's sort of purview in the long run. It'll be entirely it'll be innovation that's being spawned by the fact that this technology is now made available and in production. But that ecosystem also is also capable of supporting things like central bank digital currencies. And that's where the projects that we've been actively involved in as a technology platform with the Swiss National Bank, Bank of France, with Euro and Helvetia, really proves out the case that so when you actually have the ability to tokenize fiat, as we do to support the platform of the SDX technology today for the instant swap, that means you're one step away from being able to tokenize central bank digital currencies and actually being a platform for issuance of CDBCs, which is an obvious adjacent use case to our primary function as a stock exchange and a CSD. So now we're a stock exchange, a CSD, and a platform for issuance of CDBCs. So you can see how these things sort of they really kind of rack up as use cases when you begin to deploy this in production and stop having those sort of siloed POC sort of scenarios. So yeah, absolutely breaking that out into the production, the real world, and allowing this sort of the opportunities and the use cases to flourish in that context.
I think just to add to those points, actually, I think this is a really important topic of discussion. I think as you move into the longer term of adoption of the technology, I think the problem extends broader. When we think about and we look across the landscape, some of the DLT initiatives are being led across different regions. And I think, David's point around CBDCs is even more of a vital one. I think there's probably something of an innate expectation that CBDCs will likely be delivered across separate and distinct infrastructures. And that's separate to maybe, other infrastructures that may be supporting specific digital asset use cases within the same domestic market. And so, really there's an expectation that over the longer term, in order to really yield the value and bring critical mass of the infrastructure, we need interoperability at a scale, that we're not really thinking about at the moment. And it's going to be super important when we think about and make considerations around, for example, investor access into these assets. If we look at the digitization of private markets, I think is another great example. Today, there is no technology impediment, or not really a technology impediment, for an investor to invest in an asset within another jurisdiction. There are process and regional and compliance and legal considerations, but there are no technology impediments. But there will be in the instance where we have, domestic infrastructures and fragmented infrastructures. And so, these are all problems that the market will need to solve. And it will take, I think, to David's point, much collaboration across the board to really bridge all of these technologies together. It will take standardization. It will take, a lot of work really to kind of bring this massively interconnected network of networks, which I think is realistically where the market's going to go, as opposed to, let's say, a one DLT to rule them all.
Well, David, I guess David and Dotun would basically sort of said all the buzzwords, but maybe to also point it out even more clearly, actually would need a sort of change of mind. What do I mean by that? Having been in capital markets for 35 years and into banking, it's always this idea, I'm smarter than the other one, or I can outpace you, and actually I have this differentiating X, Y, Z, and hence I'm going to be more successful than others in the market. And this is not the way that you're going to really achieve joint efforts, and that's not the way that you're going to achieve standardization. So the comparison with the islands is probably very true in terms of all the different proofs and POCs. And a colleague of mine from a large US bank says, well, I currently have 60 POCs. And you sort of say, forget about all of them, because yes, you can literally put anything on the blockchain. It's just the question in which setup. And here, I guess, the biggest challenge is for decision makers to agree that we need more or less, we got to get rid of our fear and have a new open mindset. So an ecosystem that has an open API